Hello, everyone. This is Ed K. Smith, the co-host of the Asset Show, here with my Mr. Co-host, wonderful Mr. Rob K. Hey, Rob, how are you?
Good, mate. It's been a while.
It's been a while. We haven't done a podcast for a few weeks, so we're back on track with a super special guest, Mr. Sean Lawrence, who is the head of Asia Pacific of Kaiko.com. And we are lucky to have Sean here on the show. We met Sean at the Australian Crypto Convention in September in Queensland, had a chat, said love to have you on the show, talk about all things DeFi, anything related to crypto and crypto/DeFi data. So thanks for coming on the show.
You're welcome. Happy to be here.
Sean's based in Singapore. And Rob and I, of course, for those who've watched us know, we're in Perth. So Singapore is just basically above us. One of my favourite places to go. So next time I'm in Singapore, I'll have to pop in and see him. So I'm just gonna read very quickly a little bit of a description of who Kaiko are and what they do. I'm reading it straight off the screen, so I haven't memorised this. So excuse me for just reading. And it says Kaiko is the leading source of cryptocurrency market data, providing businesses with industrial grade and regulatory compliant data. Kaiko empowers market participants with global connectivity to real-time and historical data feeds across the world's leading centralized and decentralized cryptocurrency exchanges. Kaiko's proprietary products are built to empower financial institutions and cryptocurrency businesses with solutions ranging from portfolio valuation to strategy backtesting, performance reporting, charting, analysis, indices, pre and post trade. Wow, that's a lot. And considering at the time of this recording, which is just after the FTX collapse, for those who don't know what I'm talking about, you've probably been living under a rock somewhere, but if you've been following anything to do with crypto or Web3 space, then you would have heard what's happened in the last week or so, the date of this recording being the 16th of November 2002, for reference sake. Now, I'm sure Sean has all the answers to why all of that happened. And we're not going to put you under any pressure, Sean, because who does know what the answer is to what's just happened and what's going on.
This is our FTX crash show, pretty much, and I'm so glad we've got Sean from Kaiko on, who can actually maybe open the curtains and see some data, what's going on behind the scenes.
So. Sean, have you been busy, mate? Have you been busy over the last week with people contacting you, asking you for help?
I think there's definitely an event which is people starting to understand the need to do business properly. I think what you've seen for the last 6 to 12 months is people who are rushing to deliver solutions. And in that rush, there's two elements, one of which is a lowering of standards, and another of which is not wanting to spend very much money. And I mean this just across the ecosystem. And so what you find in doing that is a lacking of some of the structures that you might expect if you were to put your money with a bank or a traditional broker, or those kind of TradFi like infrastructures. There's a whole bunch of checks and balances and investment and duplication of infrastructure and those kind of things, which is all designed to make sure that these big problems don't happen. But they sometimes do, Bernie Madoff, for example. But mostly, it does. But in crypto space, and this is a function of new industries and evolving technologies, those kind of do it right and spend a bit of money, haven't been. And recently, everyone has started to realize that and call us. And I simplistically articulate and I say, in the development space, and particularly in crypto, there's this fail fast, fail often kind of philosophy. And fail fast, fail often is great when you're developing a web browser or kind of a charting website and those kind of things. but it's not really a great philosophy if you're dealing with billions of dollars of hardworking men and women's money. And I think that's kind of the shift that we're about to see, where people start getting a bit more serious about what they're doing.
Yes, 100%. And as you're dead right, keeping the seriousness and the professionalism at all of this stuff compared to how it has been over the past with traditional finance. There's so many people that have just been cowboying in this whole space, and it's often the Wild West is
guy from FTX.
Yeah, well, yeah, Sam, and the irony is, and I did a Twitter post on this, is the irony is, I mean, I always thought there was something off about the guy, and I'm not trying to claim that I knew this was going to happen in any way, but there was something always off about him. And he wasn't just that he was a nerdy sort of dude. There's a lot of nerdy dudes in crypto. It's sort of like 95% of us. But there was just something that didn't sit right. But also the big alarm bell should have been that part of his surname was Bankman. I mean, come on. Doesn't that say something? He has the word bank in his name. Anyway, all jokes aside.
That's funny. Hey, I think if we can watch a short Michael Saylor interview from a day or two ago, it's a couple of minutes. I think for people that don't know what happened, this could explain it. And then
Well, I think this crash accelerates regulatory intervention. I mean, in fact, in a sense, right, SBF is like the Jordan Belfort of the crypto era. Instead of the Wolf of Wall Street, they'll make a movie called The King of Crypto. This is going to bring in the SEC, the CFTC at a much greater rate. And the future of the entire industry is digital assets trading on registered digital assets trading on regulated exchanges. So to the extent that there's something good in the crypto industry, the good stuff is a digital exchange that trades 24/7, 365, trading on 8 billion Android and iPhones, digital currency available to Argentinians and Lebanese and people all through Africa and Asia that are blocked from the US financial system. The ability to issue tokens if you're a creator and monetize your brand. And the ability to deliver digital securities that trade 24/7, 365 at the speed of light, friction-free, outside of the traditional banking system, which is in essence a monopoly on assets. So those are the good things. The problem is those have been pursued by the crypto industry in an unethical, unstable, technically irresponsible fashion. And this is just highlighting the fact that a good idea pursued in an unethical, irresponsible fashion is a bad idea. I think that the regulators have it right. The idea is you should be able to register your digital asset. If you have a stable coin, you should register it with the SEC. If you have a security, you should register it. If you want your crypto token to be designated a commodity and an asset without an issuer, you ought to have a registration process. And if you want to run a digital exchange that trades all these tokens, you should be a regulated, transparent exchange that's trustworthy. And I think the regulators get it. I think the politicians get it. I think it's been a very expensive process going through Terra and Luna and Celsius and Three Arrows and now FTX's Collapse. But at this point, I don't think there's anybody in the Western world that doesn't understand the risks of allowing people to promote unregistered securities on unregulated exchanges. And so what's going to happen? You're going to see a massive shakeout. 99% of these air tokens are going to go away. They're literally the penny stocks of our era. The joke, of course, is penny stocks used to trade for a nickel, whereas some of these dog coins are trading for fractions of a penny. They're not even penny stocks. At one point, they created a token which was 0.00001 cent, so that you couldn't even read the price of the token on an 8 significant digit display on a crypto exchange. So that stuff's got to go. And what needs to replace it is ethically sound, technically sound, economically sound digital assets. The industry needs to grow up.
Michael, as a statesman in this industry, those words, comparing SBF to a Jordan Belfort, I mean, that's Those are some big words here. So is there another way to look at it in that you view SBF as a corrupt player in this industry and he needs to be made an example of, put in jail for what he has done to the space?
He was using counterfeit money and stolen money to lobby against all the virtues in the industry, against proof of work, against Bitcoin. He was working to corrupt regulations, corrupt the political process, right? When you have actors that use corrupt, counterfeit stolen money in order to undermine the industry, it's not good for anybody. And so, yeah, I mean, I think that people need to decipher this. FTX, generated an FTT token. If you trade your own token on your own exchange with wash trading, with leverage, you can park the price at any number you want. So you want to make $1 billion, you jack the price by $3 by wash trading with yourself. Then you generate $1 billion of collateral. Then you look for a bank that'll loan you money against the collateral. And of course, nobody in their right mind should be loaning money against an air token that you manipulated yourself. But of course, Sam happened to be the CEO of a bank that made loans. So he applied for a loan from his own bank and he granted it to himself. And then he took real assets like Bitcoin from his honest customers. And then he rehypothecated them, traded them, lost them. And so this is just an egregious ethical lapse, and it can't go on. These exchanges cannot continue to be unregistered, unregulated offshore.
After watching FTX collapse like that, and a bad player like Sam Bankman-Fried basically letting his own bank loan FTX money from his own token that he kind of created out of thin air. FTT was a token that they created out of thin air. How does Kaiko provide data to people so that they can see what's going on in the future? Like Ed and I, we dabble in cryptocurrency as like traders. Does Kaiko provide data for people like us, or is it more, do you guys provide it to like bigger institutions and exchanges?
So we provide it to bigger institutions and exchanges. So for example, Masari is a price display website. We provide the data to them and then they do the job of price display and distribution to retail people. So our pioneers in the back end, so it's a relatively large job to connect to 100 CeFi venues and 8 DeFi protocols and lift all that data, store it. There's a little bit of cleaning that goes on, but certainly normalization of the reference data that comes from all of the exchanges, and then replay it in a kind of easy to consume single API. And it's for people like Masari, who are websites for display. It will be Ledger, for example. So the Ledger hardware tool, the values that you see of your coins on those devices are driven by the prices that we would give them. And we distribute to oracles like super oracles. And the use case there is if you're an oracle and you're in the business of triggering smart contracts, you'll want to trigger a smart contract on a price which is validated and legitimate. Because if you didn't, and you were taking prices direct from the market, and you were to take an outlier price, let's say, imagine that the price of Bitcoin is 16.5, but there's a price on a venue that's at 15,000. If you triggered on 15,000, you'd get sued, and they would win against you. And so the oracle will come to us and say, give us a market-wide price which can be defended in the court, in a court or some other kind of context like that. And we will give them a price which we have managed in terms of outline management. So we get rid of the outline management, and that we can attest to and say it has legitimate sources. It's been averaged on TWAP or VWAP or whatever process the end client wants, so that when those smart contracts are triggered and there becomes some form of dispute, the dispute is on the basis of data which can be verified and is trustable. That's what we would do. Okay,
so how can like traders get access to some of this? Obviously, you guys have some of the best crypto data in the industry for over 10 years. I've been reading. How can we access that data?
So if you go to Masari's website, you can see that beneath their chart it says powered by Kaiko. So if you wanted to look for a price source that was from us, meaning that, like I say, it was a balanced and fair, true representation of value, then you can use those sites. If you're more institutional and you're building institutional grade solutions, let's say you're a custodian or you're a middle office platform, supplying to hedge funds, or you're a, like I say, if you're dealing with smart contracts, then so scroll up to the top.
Oh yeah.
See the chart there? See the bottom left of the
Oh
chart?
yeah.
Powered by Kaiko, yeah.
Yeah, it's funny that I've seen this a lot on different charts and various things. Subliminally, I recognize it now. I don't even know I've got your brochure that you gave us at the conference. You can't see much there. Sorry, it was folded in half. I apologize, Sean. I've defiled it because I had to fold it to put it in my pocket.
It works, though. You've still got it.
I've still got it, and it's been sitting on my desk for all that time. But so Kaiko is really the foundation and underpinning of all these different services and platforms that provide data to their clients. So it's a big responsibility. I mean, so this is the thing. When you see things that have just happened, no doubt you've shaken your head like many times, like Rob and I, like how does this happen? And I think there's a lot of people who've lost money, from people that have lost $100 to people who have lost $100 million or more, or billions of dollars. And there's a lot of people that are angry that they trusted FTX or they should have seen it. I've heard all this stuff. I've been watching all the posts, but I think they need to be a little bit easier on themselves when these smaller investors, when you look at these multi-billion-dollar businesses that just basically were trusting FTX for their money. That there was no board of directors. There didn't seem to be all the checks and balances that all of these companies.
How they didn't see what was coming. If they're looking at all this data, isn't that what these guys are supposed to do? They're supposed to see it coming.
So one of the things that we highlighted in Terra Luna was that there's this concept called asymmetric risk, information risk, which means that you only see part of the information and not the whole, and you make bad decisions on the basis of that. And so we would pitch to people and we would say, hey, look, why don't you take an aggregated market-wide feed to see where price really is? And people would say to us, oh no, I trade on FTX. FTX is a really liquid price. I don't need to see any other market. And we go, yeah, look, we get that, and that's fine. And FTX is a liquid price, and it's a relatively good price, but it's not the whole market price. And I used to say this. I'm not kidding. This is only about 4 months ago. I would go, and markets, exchanges, they can fall over. And I would quote Thailand, the Thai exchange that fell over, and people will go, don't be stupid, Sean. This is FTX. This is Binance. This is just some small exchange in Thailand. And I go, yeah, but the world's complex. And I would say, and again, this is absolutely, I would say this in pitch, and I go, best will in the world, empirically it's proven that when you have large complex operations and businesses, you can't not make mistakes. Every exchange in TradFi, every broker, every bank, they've all had these problems. Some of them have been spectacular, but most of them have been accommodated, right? Most of them have been, there are enough checks and balances. And as I said, you can't get away from this. And I would say this to people. So I said, there is this probability. And again, the response that came back to me was, don't be stupid, Sean. These people are just the most intelligent people in the world. Just some of the smartest brains on the planet are running these things. And I go,
oh
yeah,
God.
don't get me wrong. I'm not, I'm not making a comment about anyone. I'm just telling you my experience. And my background was traditional finance, and I ran ABN AMRO Clearing's brokerage. I was the CEO of the brokerages for 8 years in Japan.
Well, there you go.
Yeah. And so, like I say, we made some mistakes, and because the mistakes were, accommodatable, then the business moves on, and they weren't of the kind of illegal mistakes. It was more functional things like we had grown our business so much that our funding pipes didn't catch up quick enough, and we had to kind of rush to kind of grow our funding pipes and stuff like that. So I was just commenting, and I'm saying, when you grow that big, that fast, you always have problems. It's without exception, without doubt, you have problems. And so the question is, do you make your life even harder by doing stupid stuff like touching client assets? Or, do you have enough checks and balances around you in the process and the integrity of the people to be able to go, okay, that's fine. It's a challenge. We can resolve and remediate and move on. But you can't get away from having problems, and so look, is there an element of people, being bedazzled by the starlight
of course,
personality?
yes, of course there is, mate.
And then there's the question of, did everyone really think about what it is that crypto is meant to be? It's meant to be decentralized, and you're meant to be in control. And then when you go to a venue that says non-custodial wallet and you get an IOU for your coins, is that the venue that you want to be trading on? Or do you want to go to, I was reading this morning, Copper have just announced they've got this platform where you can trade crypto on some venues, but without moving your crypto out of their custodial wallet. So you own your own keys, but you have access to trade. And I think that's a smart, intelligent way of using the technology that we believe in DeFi, but in a way that leverages, central order books and central marketplaces are great for efficiency of price discovery, adoption and education, and liquidity. So absolutely, they have a place in the ecosystem. Saying that we're not going to have CeFi platforms is naive, right? So they're definitely having a place. But where you have a technology solution which says, the principles of my keys, my coins, and let's use that as the guiding principle, then I think we have a much more sustainable industry than we currently have now.
Yeah, I got to say, this little sucker, have I got it around the right way? This little guy, my Legend Nano X, has been almost worn out in the in the last week, because I can tell you, I didn't have everything connected to, or teed up with this, and of course, this is not perfect. These can have flaws as well. But I can tell you, anything I did have lying around that were loose amounts, $1,000 here or $1,000 there, or stuff that was on Binance or stuff that was on there, I'm going, no, that's all coming off now. That's all going into my MetaMask connected to my this.
This is one of the biggest moments in crypto history, other than like Mount Gox and a few other times like the Lunar Terra crash. I think you're right, Sean. I think people are. It's not your. What is it? Not your
keys, not your coins.
Not keys, not your crypto, whatever.
Yeah.
I think that's more important than ever now. I've lost a couple of Ethereum because I had it on sitting at that BlockFi business, which was bought by FTX. I don't know, 6 months ago or something, and I don't think I'll ever get that back. So it's like, go and put your crypto in this centralized exchange and earn all this free interest. Where were they getting all this free interest from?
Yeah, the too good to be true interest, I called it.
So this is the thing. If you look back in history, right, interest rates have been historically, this is like I said, there's no genius. Historically, between 2 and 5% in developed countries, between 12 and 15% in developing countries. It's been like that for years and years and years, like for hundreds of years, because that's the basic mathematics of money. And so anyone that comes along and says, hey, look, I can give you 40, 50, 60, 100%. I mean, I went on Binance offering Axie Infinity at 98% interest. It's nuts. So it's either something's wonky, right? Or it's a Ponzi scheme. It's
where they're using other people's money to give you money, and then everyone's piling in until it crashes.
Yeah. So look, it's, I kind of understand the philosophy of many, particularly retail users, and they said, yeah, we pretty much know it's a Ponzi scheme, but while the going's good, and as long as I can get it out quickly before the edge of the cliff, then why not? And there's some logic in a non-regulated market to kind of go, well, okay, I see why you've done it. Personally, I wouldn't, but then I'm super conservative in my investment strategies. But
I am high risk, so I'm one of those guys that, especially mid last year, I was going into meme coins knowing that they're going to crash and that they're basically Ponzi schemes, just trying to get out before everyone else. It's almost like a game at the casino. Those meme coins are literally, as long as you see it as I'm playing a game at the casino, it's rigged against me. And if you're into high risk, like I am, that I won some and I lost some, it was a game to me. But in terms of crypto investing where it's not a game, obviously we want to invest in in layer one protocol crypto that has longevity and obviously utility that we see will work out in the future. You know, just banding out some names there. I like Chainlink and Avalanche and so those things, those cryptocurrencies I see as serious, and so I'm a long-term investor in those. But if I feel like playing the casino kind of games, then I go into these meme coins when they first start.
But and that's fine. So I'm like you. I have a meme coin portfolio. My meme coin portfolio totals $450. So the point is that as a strategy in a balanced portfolio where your downside is $450 is perfectly achievable if they will go to zero.
Yeah.
But one of the things I find quite interesting is how there has been a wholesale just across, doesn't matter what class of investor you are, retail, institutional, hardcore, trading firms, a complete, almost willful disregard for basic principles like credit counterparty risk or operational concentration risk, prudential balance sheet management. And you regularly see people who say, yeah, I had a few $100,000 and I was all in Terra Luna. And you go, okay, look, I kind of see the Terra Luna play and I understand what was going on the motion, but to do 100K in Terra Luna and then 100K in Bitcoin as a safe, you're kind of safe, kind of long-term bet. And then 100K in something that's a bit more, kind of, I don't know, middle balanced or maybe a bit of staking here. It's like a spread of
diversification is so important. Of your crypto portfolio. I mean, you'd think you'd want to go across some of the layer one protocols that are strong, and then maybe just dabble with 10 or 20% in some of these casino type meme coins like Dogecoin and SHIB. I saw recently that it was something like 20% of crypto.com's balance sheet was this SHIB meme coin. I don't know if that's true or not. Do some research.
On FT. On crypto.com. Yeah, but that was held by their own clients. That wasn't their customers, was not their balance sheet. That wasn't by the customers. Yeah, that was by the customers.
We're me and Ed basically are crypto laymen, and we just say what's on our mind, and you have to go and do your own research.
Do your own research, not financial advice. If you lose your money, don't come crying to us because
don't email Ed if you lose.
No, don't email me or Rob or Sean. But look, here's the thing. I suppose it all comes down to it's all relevant in terms of the amount. So like if you've got $7 billion you're investing and you put $100,000 in meme coins, then it's nothing. But if you put this is your life savings, and if you lose this $100,000 on some sort of meme coin and you're screwed, well, you're an idiot and you basically deserve to because you were being greedy. And don't go crying to the bloody crypto police that you've lost all your money, because if stupid is as stupid does, as Forrest Gump likes to say in the movie. And
you're allowed to make stupid mistakes. I've made stupid mistakes.
Of course.
But diversification saves you from absolute stupidity.
Yeah. Just don't put in what you can't afford to lose. It's not really complicated.
With diversification, even if you do have one of your strategies which goes to zero, you live to fight another day. You have still some capital with which to go. Okay, fair enough. That was a kind of tough lesson, and that was a little bit of a punch in the the old wallet, as it were. But I've still got some of my portfolio left to kind of keep going and invest in what we all believe to be a transformative technology that really is the future of finance and the future of many other utility-based activities, rather than I've just kind of gotten rid of my mortgage, my house equity, and now I've got to work until I'm 70 to be able to kind of at least not be a pauper in retirement. So this question of balance I think is quite relevant. But in the broader sense, one of the things I wanted to say today was people say to me, crypto's dead, and this is crypto's proven to be right. Like, no, dude, seriously, let's be real precise. Crypto didn't fail here. There's nothing to do with the blockchain.
Exactly.
Central exchanges and crypto's perfectly fine. You know, it's the technology is perfectly fine on a lot of layer one coins. You know? And sure, there was some collateral damage. So Sol is, you know, layer one. So that had collateral damage to it, but that wasn't a failure of crypto. That was some collateral damage from, you know, malfeasance in the central finance kind of world. As we know,
and technically
right?
Solana didn't fail. It's because Solana was so heavily backed by and purchased by FTX. So everyone's watching Solana dive bomb now, but technically it's not the crypto technology of Solana. It's the bad exchange that had that owned a lot of its shares, so to speak, a lot of its tokens.
And if you were still a kind of, you know, a blind gambler, you might look at that and go, okay, well then I'll just go and buy a bunch of Sol now because it's so, you know, undervalued, right? You know, it's quite a cheap.
It's still a great utilitarian cryptocurrency. Yeah. But we're not saying go and buy Solana, but we're saying do some research.
Yeah.
Yeah, I think what's happened, and I'm trying to stay positive, but not in a Pollyanna way, not with rose-colored glasses, because obviously all this stuff that's gone down has been crap. You know, it hasn't been good for the industry in any way, shape, or form, other than it's probably going to get the regulators and people moving faster to get a lot of this stuff locked down where this crap can't happen again. So that'll be good. I think it's also shining a light on really the fact that DeFi is not what caused all this. It had nothing to do with decentralized finance. It had everything to do with centralized finance because it was all happening on a centralized platform. So there's nothing DeFi related about this whatsoever. And you know, it may be a case of a couple of steps forward and 5 backwards at the moment. But I think in the long run, we'll look back and go, that was really crap. A bit like the internet. Like, you know, we've been around long enough to remember this. We reference this because we're in domain investing as well. We referenced the .com crash. Now, everyone didn't get out of the internet. Everyone went, oh, God, the internet, that's it. It's done. They were saying that, though. They were saying the internet is crap.
And big companies were letting their .com domain names just drop because they thought the internet was over.
Yeah. And as we obviously know, it wasn't and isn't and won't be. It's a big speed bump, this one, but I think it's a speed bump that will go over. We may have wrecked a little bit of the undercarriage of the suspension on the car going over that speed bump, but nothing that can't be fixed. And it's going to make people a lot more, hopefully, wary. But people forget 14 years ago, mate, you were around. You were in the space of when the centralized or traditional TradFi stuff went to shit in 2008. So you've seen this movie before, right?
There you go, man. But can I just kind of pick up on a point that you just said in terms of, you know, the speed bump and the undercarriage? I take a subtly different, kind of view on that. CeFi and this another collapse of one of these CeFi platforms has done more to promote and to educate people about self-custody than DeFi had ever managed to achieve.
You're right.
You know, for one perspective, I think what we'll see is the vast majority of retail investors who will now self-custody, and they won't blindly hand over their coins to platforms that, at the very least, should be doing proof of reserves, at the very least should be having independent board directors, at the very least should be having independent auditors, at the very least should be having a fit and proper. In Australia, the ASIC, financial services license, there's a fit and proper qualification for directors and board members, right? Giving you're doing due diligence on a venue and saying, do I think that they meet the standards that I would normally apply if I were, for example, putting money in a bank or putting money at a broker or investing in that kind of spaces. So I think that's one element, is everyone's going to be doing self-custody, which is wonderful. And the other element is that there will be many, many more projects which take decentralized principles as the basis of developing their platforms. So, for example, even before FTX, we had noticed, and I was talking with some prop trading firms that we were pitching to, we had noticed the number of DeFi back-end, CeFi front-end projects that were kicking off. And I was always of the opinion that, CeFi had a limited shelf life because someone will come along and go, oh, you know what, actually, I can do all of that at the back end in a DeFi way and just have a nice front-end CeFi. And so I think that's what will happen. So I think there's team called Cypher, who do a Sol-based futures exchange that's been running for a little while. And they've got like I say, DeFi backend on Sol, but their front end is a central order book for futures. And it's, you know, projects like that which meet the the in principle, you know, goals of this technology, but provide the utility and the functionality of some form of, you know, central gathering of people to achieve an economic aim, which is order matching. So look, I am actually really quite positive about what happened. I know it sounds weird, and of course we do need to recognise the amount of, you know, economic chaos that it's created. But if you look objectively about the industry, I think the industry has been right sized to what are the principles of this technology.
Yeah, and as you said before, Sean, I see it as a necessary purge as well in the crypto industry. It just makes it stronger, I guess.
I think, but one point, I think on the right principles.
Yeah,
you know, where you actually building solutions that have a basis in the original principles of the white paper of Bitcoin, that have a basis in terms of the good business practices that should exist, whether they're regulated or not. You know, you should have independent boards, you should have proof of reserves and checks and balances, but still deliver the usability and the, you know, the functional sort of efficiency that we actually want from DeFi, because the reality is that DeFi historically has been quite a poor user experience.
Right? Yes, very much so, and that's where it's slowly changing. And smart people will come along and say, with good interfaces, that you don't have to have some sort of weird MetaMask degree to, you know, I mean, look, everyone's had the conversation with their friend or family member or someone. Okay, what you got to do is, I mean, as soon as you say the word MetaMask, I know people go cross-eyed at me when I go, Meta what? How? Who? And then you start, look, it's lost. I mean, Rob showed me how to use MetaMask a couple of years ago now, and I'm fairly, I wouldn't say I'm a techie, but I'm capable with technology. And even I'm going, oh shit, you've really got to watch your steps here, because there's so many places you can step on a landmine. And
unless you use a ledger, MetaMask is still one of the most mainstream ways to hold your own crypto.
It is,
right?
Yeah.
But look at how clunky it still is, which still goes to show to me we're real early. It's not mainstream. You can't say to your mum, go and buy some Ethereum on your MetaMask wallet yet. So that's why they're using centralized exchanges. And then, and meanwhile, a lot of people now are hardcore getting educated, forcibly getting educated, that if you use a centralized exchange and they go down, you've lost your crypto because it was on that exchange. It wasn't, you didn't have control of it like on a MetaMask wallet or a ledger. Or
the position that you sit in with what you do at, it's pronounced Kaiko or Kaiko? Kaiko. Okay, all right, okay. So I'll say Kaiko. I like the sounds of that better. So you're in a position where you sort of get to see behind the curtain of a lot of things. So you're in a spot where, you know, your typical retail person is not going to see any of this, and so you're getting to see a much, much bigger picture. This is my assumption. I'm just putting this out there, my thoughts, that you're seeing a much bigger picture of what's actually really happening on a day-to-day basis on the expansion and growth in this whole, we'll call it Web3 sector, to put it under an umbrella. So would that be an accurate statement? You're seeing a lot of stuff that your average person isn't seeing, and you're seeing things that are moving forward.
Yeah. So, you know, when we talked in Australia, and you'd, you know, the narrative that we started with was, you know, are we Kaiko seeing a winter? And this was before, you know, FTX. And I said no. I said clearly there's a winter in price, right? And that's got an element and a dynamic to itself. But when you look at the infrastructure in the industry, we're not. And actually, we're seeing quite a lot of demand. But the demand is coming from the less, if we say, fluffy parts, and certainly the less kind of, you know, sparkly kind of ego-based parts, which is, and this is, these are the metrics that I look at. And when I talk to people, particularly in the trading space or in the investing space, they kind of yawn and they're like, no, it's, you know, I've got to make money. I go, yeah, but you've got to look at really what's going on in the background. So for example, Where we see activity, it is in custody platforms across the board, all of the larger TradFi firms, but also kind of the the crypto kind of asset management space. Everyone's working on custody, and that's driven by the fact that many people are demanding institutional grade custody platforms. And then you extend that across the full life cycle of trade management. In this, if you want to use kind of TradFi terms, trade management means things like middle office, how to book your positions once your traders traded them. Risk management, absolutely. Absolutely. You go back 6 months, no one cared about the VAR, value at risk of a portfolio. Now, absolutely, they're interested in that. We have a VAR product for that. Accounting platforms. Until very recently, there was this question about how do you treat crypto? Is our crypto spot? Are they cash accounting? So I get some, so it's receivable, so it's a payable, or does it have some time value of money because there's such volatility in the price? And then the second question is, do crypto derivatives follow traditional finance derivatives, securities law, accounting principles? And all these questions that everyone's going, oh, wow, I don't know. And until very recently, when you go to your auditor will say, well, look, the materiality of that risk position is so low that we can just stick it, there's an other category in accounting. You can stick it in other, and we don't really pay too much attention to it. But as the industry got really large, they had to deal with it. So now they're starting to talk about it. And now firms, both the big firms, but also smaller, particularly technology firms that were in the audit and the accounting space, are starting to deliver platforms for this. And then it extends to surveillance, AML, KYC, reporting, execution platforms, prime and risk leverage platforms. So when you look at what's happening in that space, what you see is the infrastructure of the industry being built. And it's not the glitzy 100x kind of narrative, and it's not the fluffy NFT narrative. It's the slow, boring, but hard work. As you saw in the .com bubble, when it all burst, what happened? People quietly, just got on with it. And we ended up with, a quite, people criticize Web 2, but for many years, it has been quite a good platform for everyone to develop the business, be more economically active, be more efficient and productive in their I'm talking about, the producers, widget producers and, florists and those guys. Web 2 has been amazing for the general economy, but that was all built off the back of not 100x valuations of .com bubble companies, of just people working in the background, guys coding in their bedrooms. And
I think that's a good point, Sean. If everyone's looking at the price after the FTX collapse of like Bitcoin, and they saw it touch 15,000 US, the people behind other layer one protocols, including like Ethereum recently had its merge. But imagine the Solana devs and the Avalanche devs and all these other, they're in the background just going, whatever, they're building. So what's going to happen as all their utility and technology improves over the next 6 months to 2 years? It's not going, crypto is not going to zero because of this. It's a flush out purge. Everyone else is building in the background. The future's bright. And sometimes you need death and rebirth in an industry to make it stronger and more transparent.
Yeah. So there's that element. So I agree. So there's that element of infrastructure that's rolling along. I think another element which is more focused on the on price and market activity. The other thing that's happening is that you see that people's not willful blindness, but people's lack of attention to risk management is starting to become quite a painful experience. All the time the market's going up, if you don't really know what your implied vol really is, if you don't know what your value at risk really is, these kind of things didn't really matter because no one was particularly kind of looking. But now people are. So for example, we produced a value at risk calculator that you give us a spot portfolio, and it'll give you, and this value at risk is a mathematical calculation in TradFi which says, on the basis of a kind of time window, let's take it, 3 days ahead in the future, on the basis of a probability, let's say 99%, you can estimate how much money you're likely to lose. It's called value at risk. And so we have a calculator. We were pitching this 6 months ago, and people would respond and go, oh yeah, that's interesting. I used to be a trader, or, I'm kind of maths geek. That's kind of interesting, but it was always an academic response. It wasn't really kind of like, yeah, man, my risk manager's been on my back every day. I can't trade anymore because he said I'm busting my limits. There was nothing like that. But now this product is getting much more traction. And similarly with implied volatility. Implied volatility describes the sensitivity of movements in price for particular assets. And implied vol in the markets is quite unreliable. It's known to be unreliable. And the exchanges that are publishing it, derivatives exchanges, don't have transparent methodologies. And so we built an implied vol calculator, which takes market data, so the actual the actual trades that have occurred, but also complements that with bid-ask quotes as well, and some small adjustment in terms of how we look at the back data to provide an implied vol, which we think is both transparent, so you could repeat it if you wanted to, but also it's more kind of balanced. And those kinds of products you're starting to see much more of, because people are starting to go, oh wow, I do have a lot of risk on my books. And now here's the rub: my investors are starting to ask me what it is I
no
do.
shit they are. They really are.
and the answer that was like 100x, it's not good enough anymore, right? You've actually got to do the kind of things that you were meant to do all along.
Imagine that accountability, mate. Can you imagine it? Accountability in the crypto space. Who would have thunk it?
Yeah, here we are.
And one of the things I find quite an interesting dynamic is that there is a kind of there is a maxi kind of response which says, "Oh no, mate, you don't need that, mate, because it's all on the blockchain. This is going to be, it's just doesn't matter. Trust us, man. It's verifiable." And you go, dude, look, I get it, right? And absolutely, I believe in that. That's why I moved from traditional finance across to crypto. But there's just some basic principles of diversification, of due diligence, of prudential balance. This is just the basics, man.
Blockchain doesn't prevent you from being stupid. I mean, you can still do stupid shit, and the blockchain is just there to remind you of what that stupid shit was that you just did. Forever.
So I was reading an article this morning about proof of reserves, and so the author of the article kind of made the quip, and he said, proof of reserves are great, but all that means is that when they steal your coins, you can see them stealing your coins. It's like,
oh man,
stop them stealing your coins. So the only way to do that is self-custody. And these kind of platforms that are coming along now, where you keep hold of your keys, but they allow you to trade in a centralized fashion, but you still keep hold of your keys, and they can't steal your assets. So look,
but it's one of those things. We'll love to have you back on again in the future, because like in another year or two. Not saying it's necessarily going to be that long, but I mean, that a lot happens. Look what's happened in the last 6 months. Imagine if we just did this. Imagine if you had been on our podcast 6 months ago, and now we're on again, thinking of all the things that have happened. It's like, oof. It's never boring. This is one thing about if you're in the Web3 space, you are never ever bored, because it is just at a pace that is hard for most people.
It's almost a full-time job being in Web3, even if you're not making any money, just keeping up with everything every day.
Yeah, it's great.
I've got one more question.
One more question, go, mate.
So, Sean, obviously Kaiko, with its smart crypto data for about 10 years, has a lot of insights into what's going on. And the normal kind of traders, we like to be able to see some data and maybe get a bit of an edge of what's maybe coming up. I'm not saying that Kaiko has all that answer and has all of those answers, but I asked it a little bit before. Do you have any just tips for regular traders and crypto investors, even if they're being careful, where they can kind of, instead of just putting their money into a token, is there anywhere that you could kind of recommend that they go to have a look at what's going on? I know you mentioned Masari.io.
Yeah.
Are there any others, or is there anything on the Kaiko website?
So we provide data to people like Chain Analysis, and so people like that, and they're not a client of ours, but Elliptic, where there are services where they're using our core of data, right? So we're a data distributor, and that's what we do really, really well. And then there are people who take that and do something with it. So I would suggest that people like that you can look at. We also have a free research product, so anyone can subscribe to it and anyone can sign up. And we use that as a basis of saying to people, the message that we're giving there is, if you had our data, you would be able to do these kind of analyses. So we wrote a paper about how you could see Terra collapsing on DEX 4 days before it happened on C5.
Wow.
And so really what we're trying to do is say to people, look, this data is all out there. And the element that we keep trying to say to people is, stop looking down a very narrow funnel. Stop saying, well, I trade on FTX, so I don't need any other data. It's like you do. You need to see, for example, we keep trying to say to people, have a cross-market feed so you can see price dislocation. You can see where venues are having materially different prices from other venues or from the average. And then you can kind of go, oh, wow, that tells me something. I'm not saying it tells you something that's going bad, but it is an anomaly that you should look at and go, oh wow, actually, yeah, I should probably look into that. These kinds of things where you're using data kind of much more intelligently to give you, in the very first instance, some line of defense to be able to kind of not get knocked over like people have done at FTX. And then if you're intelligent enough, this isn't our game, is predictively looking at the world and understanding the way that the world is going, then these are the kind of things that you should be doing with data that people like Kaiko can produce.
Yeah, so from my understanding, Kaiko has all the data and basically all the information's there, but Kaiko doesn't offer advice and it doesn't say do this, do that. It's like, here's all the data, you use it to win.
Yeah, absolutely.
Whether you're going to use it.
Yeah, it's cool. I'm looking at the research newsletters page on Kaiko now. This is the thing. If you're not into data and analysis and numbers, you shouldn't be in crypto, because basically that's what it is. So if you go, oh no, I'm not, I don't want to read all this thing, I don't want to do any research.
You know what? And some people are busy. We're all busy, right? So if you're not going to do it yourself,
this is why this is good.
You want to go, if you can't even, don't even have the time to dissect the Kaiko data and read all their newsletters, at least use a business that's getting their data from Kaiko, and they're like shortening it for you to save you time. That's what I think people should be researching.
Exactly.
One thing I would recommend is to sign up for the blog. The blog comes out every couple of days. It's written directly from the the research team by Five Research
great.
That we have, who's just excellent, and we get a lot of great reviews. And Clara, who's the head of the team, has been on CNBC a number of times because of the quality of what we produce. But the blogs are great because the blogs are kind of bite-sized. It's not like hugely deep dives, although we do the deep dives as well. But if you're kind of like the average retail investor, to read that blog and kind of go, oh right, okay, now I understand. That's the kind of, and it's all data driven. We don't do opinion pieces. We don't do subjective. Because of course the whole idea is that we're data-driven.
Yeah, that's what some people want.
Yeah.
Well, I'm laughing out loud at the latest one that is entitled "Crypto Liquidity in a Post-Alameda World." That's good. And Alameda, for those who don't know, was Sam Bankman-Fried's separate, bank, for want of a better word. How would you describe it? Alameda. How would you describe it, Sean?
The Alameda started as a prop trading firm, and then their idea was that they'd say, well, look, we're market making on a market. Why don't we just knock out the middleman and become the market? So they created their own exchange, and that model of evolution is relatively normal, except for the fact that in normal cases, what happens is you create your exchange and it has to be separated, and it has to have an independence and checks and balances and everything, all those kind of things. So the event of what they did is not necessarily kind of bad. It's how they did it is the challenge for them.
Yeah, they had the built-in backdoor stuff, apparently, from what I've been reading. Backdoor in the accounting system, so he could transfer funds back and forth between the two, and no one would see triggers that it was happening.
I think it's important for everyone who's interested in investing in cryptocurrency going forward to research for themselves what happened to FTX, and then you should be able to learn a few things, especially how to keep your custody of your own crypto.
Yeah.
Yeah,
If that's all that happens, that's a good thing, I suppose. But there's going to be a lot more that comes from this for sure. So, all righty. Well, look, Sean, thank you. This was high level stuff. It says there's some people who are watching this show. They're just getting into this space for the first time. Some are well experienced, and some of the things we talked about may have gone over some people's heads, and other people would have gone, "Oh yeah, I know all that." But if there's anyone that needs to get in touch with you, how can they best find you? Just by going to the website or looking you up on LinkedIn, I suppose.
Yeah, LinkedIn. I'm sean.lawrence@kaiko.com. Or you can, like I say, if it's a commercial inquiry, there's a go to our website, and like I say, you can put an inquiry to sales@kaiko.com. Either way, please reach out wherever you are. Say maybe west coast of the States. We've got people in the States, of course. We've got people in Europe because we're headquartered in Europe. But yeah, please do let us know if you want to talk about data and how you could use it to protect yourself and build better solutions, whatever solution it is that you're building.
Fantastic. Thank you very much.
Thanks so much for coming on to our FTX crash show, Sean.
There wasn't. If you recall, it wasn't going to be this.
No. This we did book this several weeks ago, but it was not on the cards at the time. FTX was, nothing was ever going to happen. It was rock solid. Oh dear. Anyway, on that note, thank you for watching, everybody. If you haven't subscribed to the podcast, please do so. We'd love to have you as a subscriber and get to see what the next episodes are that come out, and like it as well. If you liked it, why wouldn't you? With people like Sean, please go ahead and like it. Give us some love, and we'll see you on the next episode. Stay safe, stay custodial, stay DeFi. Bye for now.